Kari Phillips, how are you doing today?
Hello, Rick Brinkus. How you
Yes,
doing?
yes, Rick Brinkus here with Keller Williams Realty, the marketplace. And just over my shoulder there's a little commercial in the background and way that you can get in touch with me. But I've got lender extraordinaire Kari Phillips. Kari, we're going to go over rates are super low right now. Tell us a little bit about yourself, and then we'll kind of dive into what's happening.
Yeah, I'm Kari Phillips. I'm the owner of Ratewise Mortgage, and I've been a lender for 20 years. And I've known you and Terry for 10 years and work with you all. So I'm happy to be here, and I'm glad to talk mortgage smack today.
Yes, yes. No, just lots of questions, just some incredible stuff. The interest rates are just, I just pinch myself. 30 years in the business, when I got into the real estate business, interest rates were at like 13%, and they kept getting lower and lower. And then once they got below 10, it was like, oh my gosh, this is crazy. Below 5%. What are some of the interest rates that you're locking in, 30-year, 15-year? What rates have you gotten people recently?
Well, in the VA world, we're locking people on a 30-year mortgage at 2.5%.
Oh my goodness.
In the FHA world, we're locking people at around 2.25, 2.375, no joke, 30-year fixed if they have above a 660, 680 FICO score. And then a regular conventional is around 2.75 to 2.875. And these are 30-year fixed mortgages. Wow. And no points. I mean, you talk about pinching yourself. I'm living in Disneyland every day right now, because every call that I make to a past client, it's hey, these are rates, and they're locking it 1% plus lower and saving a ton of money. So those are just fun calls.
Oh yeah, no doubt. It's just so exciting. And 15 years even better than those?
15 years is usually about 0.25% less on a conventional. It's only about 1/8% less on FHA and VA, but basically rates are in the twos. I've never said that in my 20-year career. Twos. So they're great.
Yeah, no, fantastic. And one of the questions, and it's kind of not as Paul Harvey would say, there's the rest of the story. People will ask me just kind of conversationally. I'll see them at a restaurant, or they'll call up and, hey Rick, what are rates at? And it's not really that there's not enough information with just that one question. Would you agree with that?
I would agree with that, and I think you can generalize and say, gosh, everything that I'm reading, or, and I was talking to Kara the other day, they seem to be in the twos, but you can follow that. And I say this to a lot of realtors, because I always compare you guys to Disneyland, and I'm kind of the dentist. They want to go to the Disneyland first to talk through, rates and the fun stuff. And then they get qualified and do the serious stuff, and the financial stuff with me. But they're going to go to you first. And I think that if you were to say, here's a general idea, but there are 24 things that go into an interest rate, 24. And I'll give you that list. Wow. And maybe you can put that out there during this podcast, after the podcast. But it's, whether it's a fixed rate, whether it's an ARM, whether it's, a loan amount under 150,000, whether it's a purchase, whether it's a refinance, whether it's a cash out, whether they have a 620 to 660 FICO score, 660 to 679. There are tiers in the credit score, and dings in where the rates are. So lots of factors there. So
it really makes sense. I mean, if you think about it, of course, somebody that has different credit scores, they're going to get different rates. Somebody that's getting a lower loan amount, maybe 125,000, is going to be different than somebody that's getting a larger loan amount, or if they're doing a refinance versus a purchase or cash out. So thank you so much for explaining that there. Yeah. I didn't realize there was 24 factors. That is incredible. Thank you so much.
Yeah, I'll give you the list.
Okay, outstanding. And some of your past clients, I've had a number of people, pulling some cash out and buying a rental property, kind of using this low, what some people are referring to as almost free money, to go out there and actually create some wealth for yourself. Have you had some past clients experience that as well?
Well, we're seeing probably 1 out of 10 clients right now do a refinance, and I'm also giving a pre-qualification at the same time, because they're getting cash out and they're buying another. Investment home loans used to be rates in the 5s, and that was a really good rate. Investment rates are now in the 3s, which is amazing, where if an investor purchases, every $100,000 is about a $400 payment.
Wow.
So you can get a $200,000 house, have an $800 a month payment, and then rent it out for $1,200. So, you know, lots of investors coming out right now, especially they feel like they're getting great deals out there because of you know, just the market and whatever's going on. Plus interest rates just make it so affordable for people to buy and make a profit.
Sure. Oh, absolutely. And putting the money in the bank, even in a CD, it's just not getting the return that you can with a rental property. So
for sure, yeah.
Kari, Terry and I don't. We have a number of rental properties that we have ourselves, and wholeheartedly believe have helped numerous clients create a lot of wealth with that, pay for college education for their kids and so on. We don't do property management ourselves, but we do have a property management division at our office, and they do a terrific job screening the tenants, helping find that great tenant, writing a good, strong lease. They've got a whole team of repair contractors if they need something, and just making sure that you're protected the whole way through. So invaluable.
Having a management company is, I think, the only way to go. You know, if you own an investment property, have somebody else manage it. It's worth the percentage for sure.
Sure. No, a lot of expertise with that. So the other thing that has become very conversational today is forbearance agreement. People hear forbearance agreement, and many times they think, hey, this is free money or an opportunity to not make payments, and I don't have to pay it 100% of the time. The belief is that I don't have to pay this until year 30. They're putting it on the back of the loan. Is that always the case? Are there guidelines? Is it changing kind of several times? I've heard that there's been a couple of flip-flops on different programs out there. So can you talk to us a little bit about a forbearance agreement? And kind of the second part to that question is, how would that affect if somebody is in a forbearance agreement and then they think they may want to refinance down the road, or they may want to sell and buy something here within the next 12 months or 18 months?
Yeah, sure. You know, there've been a couple changes in the last 6 weeks. We've gotten guidelines direct from Fannie. These guidelines that I'm about to state are Fannie, you know, driven. But what I've learned recently is that different investors can make their own rules, seems like. So take that for what it is. The rule it used to be that you could skip 3 payments and then it was all due at once. About 2 weeks ago, we got guidelines that stated that you're able to.
Hold on a second. Let me just see if I understand what you said.
Sure.
So these rules came out. People heard that they could do a forbearance agreement. There would be no late payments, and they missed their payment in April, May, and June, and now all of a sudden it's July. And some of the time you're saying that now July, all 4 payments are due?
Correct. That's what it was. And then we got a guideline change from Fannie that said, hey, you're able to go 12 months without making a payment, and then that amount of money will be added on the back end. As far as how it will impact if you were in forbearance and you were trying to refinance or trying to purchase another home, the rule is that you have to come current with all of your payments before you can refinance or purchase. They figure if you're in forbearance, you're at a hardship, and so it wouldn't make sense for them to give you additional financing without you showing that you're not in a hardship. And then you had mentioned that you had a couple clients the other day that you were sitting across from, and they had a different experience. So I'm curious on that.
Yeah, so on 4 different occasions in the last couple of weeks, we sat down. They said, "Hey, Rick, we're taking advantage of the forbearance agreement, and our payments are going on the back end." And I said, "Well, let's maybe that's the case, but let's go ahead and call your lender just to verify. Would that be okay?" And in each one of these 4 cases, they said, "No, the expectation is that all 4 payments are made in July." And shock with the people sitting across the table from me, they said, "I don't have 4 payments. I could maybe make up some. We need to kind of do, some sort of an agreement." And they said you would have to apply for a loan modification. So that is actually a formal applying for a loan modification, and it can be one of anything. They could say, we'll give you 90 days to catch up. We'll give you 12 months to catch up. It may be put on the back end. And there may be some people that were downsized or lost their job. And when that happens, sometimes they're automatically denied for a loan modification when that happens. So, kind of going down the road a little bit, we're still in a little bit of area that I kind of refer to as wet cement. There's some changes that may happen. It's not exactly cast in stone yet. And some of those homes may end up where the people are not able to make up the back payments. And then all of a sudden they become 90 days late, 6 months late, and a notice of default could be filed going
Yeah.
on.
I mean, end result is really call your servicer and find out what, and I would try to get everything in writing to say, what are your rules? How does it work? With you specifically, because you had 4 different responses from different clients. I've got a guideline that I'm reading that is different, a little bit different. So, I would think that it could be a servicer call, an investor call of how they want to handle that, because they bought the loan, they can make the rule.
Sure. I was at a client's house yesterday, helping them sell their house here. They're buying out of state. And when they ran their credit and everything, AAA, he says, I've got an 800 FICO score. That's one thing I really pride myself on. And my lender called me yesterday and said he had called his servicer to get some answers. And they said, oh, we've got you taken care of. Everything's great. He has an automatic deduct. So his payments actually have been made.
Yeah.
When they put him into a forbearance agreement, his lender said, well, I can't do the loan if you're in a current forbearance agreement. He goes, well, I'm not. I just asked how it works. So sometimes just by simply asking, you need to be careful, be specific, that they don't put you into a forbearance agreement.
I actually heard of that from one of my past clients named Brian. He did the same thing. He was just calling to inquire, and they just, when I pulled his credit, it said that he was in forbearance, and he had no idea. He said, oh no, I've been making my payments. So you're right in that. You just gotta, so what do you do? Not call and get information from your servicer?
I think you just kind of circle back at the end of the day. I think, everybody has good intentions, but you have somebody answering the phones and they're typing very fast, and the 10 calls before them all wanted to do a forbearance, and they just kind of go down that path. So you just slow them down a little bit and ask the question. So a couple of things, just when we hear servicer, and we also hear investor on the loan, can you kind of explain the difference between a servicer and an investor when we're talking about mortgages?
Sure. Well, when I do a loan and I fund the loan on my warehouse line, I have investors that I can sell to, and the investors will either buy the loan and then bundle it up and sell it on the secondary market and not service it, or the investor can actually also be the servicer. So a servicer is the one that you make the payments to. The investor is the one
servicing the loan. You're making a payment to XYZ mortgage company.
Yep.
And they may or may not be the end investor.
Correct. Correct. Yeah.
And so rules may change even within the same servicer, even though two past clients, 2 friends may be making their payment to the same mortgage company, ABC Mortgage. That same servicer may have 2 different investors, and they may have 2 different answers on a forbearance agreement. Is that
correct? You're spot on right there.
Yep. And some of these investors, the household names like Fannie Mae and Freddie Mac, it could be something like that, or it could be the school teachers credit union in Iowa, right? That has purchased some mortgages and they're investing in the retirement plan. So you could get vastly different answers and rules depending on who the investor is.
That is correct. Yeah.
Perfect. So yeah, no, just, we hear things like that coming up all the time, and we just want to get clarification going forward with all of those. Now, the market has been blistering hot. We've had 6 straight weeks where the number of sales have exceeded the number of new listings coming on the market. We've seen the inventory kind of go down and down. We've seen multiple offers many times. Is there something that a buyer can do besides getting pre-qualified? Is there something that would strengthen their offer compared to if they were in competition in a multiple offer situation? Can you talk about that?
Sure. Well, let's define what a pre-qualification is. It's where a lender takes an application, they run credit, and they say, you know, if you can prove everything that you've told me, you should be able to qualify for 200,000, this much down payment, and this is your actual payment. They give a letter that says that they've taken an application to run credit. That's probably 90% or 95% of what offers come, and you can answer this better than I can, but every agent that I've talked to, you know, 9 times out of 10, if they get 10 offers on a house, most of them just have a pre-qualification letter.
Correct. Exactly right.
What is the best way to do it, and what we pride ourselves in at Ratewise is we get all the documentation up front, and we, you know, income, assets, we do all the background checks, you know, we anything that's done that we can do that doesn't have anything to do with the property that they're going to buy, but everything that has to do with the borrower, we get signed off by an underwriter, and then we give what we call a WISE approval. It's a full underwritten pre-approval that actually tells a seller, essentially, you're not going to have a mortgage bomb happen in the middle of a transaction, right? Because sometimes that happens where, you know, a client says that they make something, you know, in income, and then when the verifications of employment or pay stubs come in, it's much less than what they really make, and then they don't qualify, and then they can't buy the house, but yet they got in contract, they paid for an appraisal, they now lose their earnest money. You know, you're gonna do it anyway, is what my message is to my clients. And so why not do it before you're in contract, before you're at risk? Do it when you're, you know, when you're sitting on a Saturday, not worried about closing on a contract or stressed out about that. Just get it done, because it lasts 120 days. But that, with a phone call from a lender that's to the listing agent saying, hey, listen, we verified this. This is what this letter means. They are good to go. This is my personal cell. You can call me, get status, but they are good. You're not going to have to worry about a mortgage. That is something that also helps the client stand apart, because it's just not the normal. So my advice to any borrower is to find a lender that's going to go to that full extent, even without a contract. Many lenders do not do that because it costs money to pay an underwriter, and, you know, when you don't even have a contract yet. My belief is those people that go to that extent, that get fully underwritten and approved, do the work, they're gonna close escrow. They're motivated. It's gonna happen for them. So it's not a waste of time and money. So
sure. No, that's absolutely spot on. And if they found something and the seller needed to, for a variety of reasons, close in 2 weeks or 3 weeks instead of 45 days, because you've done all that work, could they close that loan quicker?
Sure. Our average closing time is 18 to 21 days on those people that get the WISE approval. And that's because the appraisal takes a couple of weeks. You know, if we weren't waiting around for the appraisal, you know, it'd be even sooner than that. But and that is attractive to listing agents and to sellers that need to sell immediately. And if they can close 2 to 3 weeks early than the normal, you know, market, then that's helped get offers accepted as well, because we put right on the letter, can close in as little as 18 to 21 days. So, you know, sometimes they don't want to close that quickly, but at least docs are out quickly, but then we're just waiting around to fund, and there's no stress.
Yeah, perfect. Well, and the values right now are, it is lots of brisk activity. Buyers are out there. They're taking advantage of these low interest rates. And we saw in 2006, years and years ago, we had our high water mark. Then the Great Recession, a big meltdown, and it's been coming back year after year. We matched that in May. The high water mark of the combined total of single family and condos was 295,000. We hit that last month in June. We eclipsed it for the first time. It was,
I didn't know that.
305,000. In many cities around the country, they eclipsed the high water mark years and years ago. In Las Vegas, we were still inching and clawing our way back. We finally, last month was the first time we did it. So what Terry and I did is we created a website, and you can instantly find out the value of your home. If you just click down below, if you're watching this, there's a link on there. and instantly just put in your address and we'll be able to tell you instantly what your home is worth. Actually, the website will be able to instantly tell you what your home is worth.
That's cool.
So that's really helpful. Somebody that's watching this, if you also want to get more information, if you got some great ideas here, if it caused you to think a little bit more, you can reach out to Kari or myself, and go ahead and subscribe down below. We have lots of great content and information designed to help you get more information about what's happening in the Las Vegas market. So Kari, if somebody wants to reach you, what would be the best way that somebody, if they had specific questions and wanted to reach out to you?
Sure, yeah. You can call me personally on my cell at 702-375-3401, or you can go to my website at ratewisemortgage.com.
Awesome. Well, thank you so much. With me, there's my sign right over there. The phone number is pretty easy, 702-456-5959. Rick Brinkus and the Brinkus team at Keller Williams Realty, the Marketplace. Kari, thanks so much. We'll have to do this again. It was super informative. I had just a ton of notes, and as you and I were preparing for this, I had a couple of questions, and then I had a page and a half of notes and great information. So
Well,
thank you so much.
Always love working with you guys.
Awesome. Thanks, Kari.
Uh-huh.